welcome to the deep dive. We came across a really interesting piece from the Motley Fool.
Oh, yeah. Which one?
It's titled, One No-Brainer Growth S&P Index Fund to Buy Right Now for Less Than $500. And, well, that title.
That'll grab your attention for sure. A no-brainer, huh?
Exactly. So what we want to do in this deep dive is really get into the core of their argument. Why this specific ETF?
The Vanguard S&P 500 Growth ETF, VOOG, right?
That's the one, VOOG. Why do they think it's such a compelling investment, like right now?
Okay. Well, it's definitely worth talking about, especially with, everything going on in the economy.
For sure.
The article does mention some significant headwinds, those concerns around President Trump's tariffs.
Yeah, I saw that, the 145% one on Chinese goods.
Exactly that one. It's kind of casting a shadow, potentially, on corporate earnings, the whole economy, maybe.
Absolutely. And an article points out growth stocks seem particularly sensitive to that kind of uncertainty, don't they?
They do. They often rely on really strong economic conditions to fuel that expansion. So yeah, any hint of a slowdown, investors get nervous.
Right. So with that as the backdrop, the article's main idea gets really interesting. Could this worry actually be, well, an opportunity for long-term investors like you?
That's the million-dollar question, isn't it? The article basically frames this pullback in growth stocks because of the tariff worries as maybe a decent entry point if you're thinking long-term. It suggests, sometimes when the market gets jittery.
That's when you find the deals.
So potentially, yeah. That's the argument they're making. Compelling opportunities might surface.
Okay. So before we get to VOG itself, the article kind of starts broader, making the case for ETFs generally. For someone maybe newer to this, why are ETFs a good starting point, according to the piece?
Well, the article describes ETFs, exchange-traded funds, as just a really efficient way to get diversified right from the start.
Diversified how?
Think of it like instead of you having to buy individual shares in dozens of different companies.
Which sounds like a lot of work.
It can be. With an ETF, you buy one single thing, one fund, and it holds a whole collection of stocks, usually linked by a theme like growth stocks in this case.
Ah, I see. So it bundles them up for you.
Precisely. And they can track big indexes like the S&P 500 or smaller, more niche ones.
So it gives you that instant piece of a bigger pie. That does sound less intimidating than picking single stocks. And creating them is easy, like a normal stock.
Yeah, the article mentions that they trade on exchanges all day long, just like Apple or any other company stock, easy to buy and sell.
Okay. And they mentioned something about costs, the expense ratio.
Oh, definitely. Super important point they made. Keeping that annual fee, the expense ratio, low is crucial. They said aim for under 1%.
Why so important?
Because over decades of investing, even fees that seem tiny can really add up and eat into your overall returns. So keeping costs down helps maximize your gains.
Makes total sense. Okay, let's zero in on the star of the article. The Vanguard S&P 500 Growth ETF, ticker VOOG.
Right, VOOG.
The article mentioned a price around $310 on Monday. I just checked, it's around $326.50 this afternoon, Tuesday. Did take a bit of a dip today, though.
Markets fluctuate. Happens all the time.
True. But why the no-brainer label? That's pretty strong language.
It is bold. The article's logic seems to be that VOG gives you access to really established companies, but ones that are still focused on growth.
So not like risky startups?
Generally, no. These are often big, mature businesses. They have track records. But the key is they still seem to have fantastic long-term prospects, even with these current economic headwinds we mentioned.
That established nature maybe gives them some resilience.
That seems to be the idea, yeah. A bit more stability, perhaps.
And it names some specific companies inside the ETF, right? The big ones.
Oh, yeah. You'd recognize them. The top holdings mentioned were NVIDIA, Apple, Microsoft, and Amazon.
Okay, yeah. The heavy hitters, titans of industry, really.
Absolutely. Companies that haven't just, dominated their fields, but are still pushing the envelope.
And that's key, isn't it? The article mentions they aren't just sitting back.
Exactly. That's crucial for growth. It highlights they're moving into new areas, exciting stuff like AI, even quantum computing.
Wow, okay.
Which suggests they're actively planning for future expansion, not just relying on past glories. That's what you look for in a long-term growth investment.
Now, growth investing often makes you think tech. Is VOG just a big tech fund then?
That's a fair question, and the article gives some good detail there. Tech is a big slice, no doubt, around 37% or so.
So quite significant.
It is. But importantly, it's not all tech. The ETF actually holds companies across 10 other industries, too.
Oh, okay. So there's diversification within the growth theme.
Yes, exactly.
Yeah.
Which can be really helpful, right? If tech hits a rough patch, other sectors might help cushion things.
That is reassuring. Did they give examples of non-tech companies in there?
They did, specifically mentioned Eli Lilly, the pharmaceutical giant.
Okay, healthcare.
Yep. Then Visa, huge in payment processing.
Financial services? Sort of.
Kind of, yeah. And Costco Wholesale. Big box retail.
Interesting mix. Pharma, payments, retail, alongside the tech giants.
Shows that growth isn't just limited to one sector.
And how does the ETF, keep up? Does it always hold the same companies, or does it change?
Good question. The article explains it tracks the S&P 500 Growth Index.
Okay. And that index changes.
Yes, that's the key. It's not static. The index periodically reevaluates companies based on growth criteria. Stronger growers might get added.
And weaker ones dropped.
Potentially, yeah. Or ones that just don't fit the growth profile anymore. The ETF, VOOG, automatically adjusts its holdings to match that index.
So it ensures you're always invested in whatever currently qualifies as the top growth players within the S&P 500.
That's the mechanism, yeah. It keeps the portfolio relevant to the growth theme over time.
Okay, let's loop back to those market worries we started with. The tariffs, the economic uncertainty. The article says this has made investors a bit wary of growth stocks.
Yeah, that's a really core part of their opportunity argument. The idea is that this tariff uncertainty
raises worries about costs. Consumer spending.
Exactly. Potential cost increases for businesses, maybe people tightening their belts, and companies that really need that strong economy to grow fast.
They look riskier in that environment.
To some investors, yes. They might pull back a bit, get more cautious, maybe shift money to perceived safer assets for a while.
And we've seen that happen with VOG itself this year, according to the article.
We have. It specifically mentioned the ETF had slipped about 15% since the start of the year.
15%, that's noticeable.
It is. And it reflects that broader nervousness, that move away from growth stocks among some investors due to the economic picture.
And this is the article's main point, right?
Mm-hmm.
This very dip is where the opportunity lies for long-term folks.
That's the crux of it. They frame that 15% pullback not as a reason to panic, but as potentially an attractive entry point.
Lying low, essentially.
Well, lower anyway. Buying into these, what the article sees as fundamentally strong growth companies, but at a better price than maybe a few months ago.
Getting quality assets on sale because of, maybe, temporary market fear.
That's the narrative, yes. A discount driven by short-term jitters rather than a fundamental problem with the companies themselves.
And they didn't just pull this idea out of thin air. They offered some history to back it up.
Right. The article kind of zooms out and reminds us about market cycles. History shows we always have periods of worry, corrections, even downturns.
But the market recovers.
The long-term trend has always been recovery and then further growth. Always. So looking back, these moments of peak concern often turn out to be pretty good times to invest in quality for the long haul.
It makes you think, yeah, hindsight is 20/20, but the pattern is there.
It is. So the historical perspective supports the idea that current pessimism might be creating future opportunity.
Okay, so let's try and wrap this up. Based on our deep dive into this Motley Fool article, the big takeaway seems to be this. Yes, there's economic uncertainty. Yes, tariffs are impacting growth stocks.
Definitely.
But something like the Vanguard S&P 500 Growth ETF, VOG, offers you a diversified way into leading growth companies that still have really strong long-term potential.
And it does it through one single, relatively low-cost investment.
And that recent price dip, that 15% drop, the article argues that could actually be the signal for long-term investors, suggesting it might be a good time to consider getting in.
Precisely. Short-term noise, creating a potential long-term entry point for quality growth assets. That's the core message.
That certainly gives you some food for thought. And maybe leads to a question for you listening.
Yeah.
How do these kinds of short-term bumps in the market, the tariff fears, the economic jitters, how do they actually influence your long-term investment plan? Do you see them as risks to avoid or opportunities like the article suggests?
And maybe thinking beyond just the sectors we talked about, tech, pharma, payments, retail, what other areas out there do you see really driving significant growth in the coming years? Something to ponder.